Next, in my Are Options a Scam series, I will look at the covered call in a sideways market. I've been backtesting strategies for over 25 years. The goal is to find a system that is resilient, one that has minimum drawdowns and decent returns. The standard I use is the S&P 500. If the system can outperform the S&P 500 on a risk-adjusted basis with black and white rules, then I consider that a good trading system. The most efficient way to backtest and eliminate a potential trading system is to take it through the toughest test periods first. If it can survive the tough test periods, then it is worth backtesting over longer time periods. The first thing I do when backtesting is I take the system through all 4 market types to see if it survives. If the system can survive these markets, then it may be a viable trading system and worth further testing through years of time. My experience has taught me that when trading options, there is an edge when selling premium, and when buying premium, a low probability position is created. The low probability positions lose money over time. Therefore, as of now, my options trading scam series will not involve backtesting a long options premium trading system. Some courses and services are solely based on selling well-known trading structures and promising you they can make money trading them. This series on options trading scams is dedicated to backtesting the well-known options trading structures. First, I need to go over the type of structure I'm backtesting, and then I'll go over the management rules. Now, first I need to explain the 3 types of trading styles. So number 1 is always on, number 2 is opportunistic, number 3 is campaign. I will be using an always on style trade system in my backtest. Always on means that the position is always on, much like a long portfolio. With the options portfolio, when a position closes, I will open a new position on the same day. The second is an opportunistic style of trading, and this is a variable trading system that puts trades on when there is an opportunity. A day trader falls into this style of trading as they look for certain patterns, and when they emerge, the trade is opened. Now, the third style is a campaign style, which means that a position is open based on a calendar or time frame. A good example of this would be an investment in a retirement account where more money is added to the account on a monthly or quarterly basis, and the capital is applied and added to current positions. Now again, I will be using an always-on trade style in my backtest. In this video, I will backtest the covered call through a sideways market. And I've already backtested the covered call in a bull market, and you can see the link in the description for that video. So now here are the rules for this particular backtest. Number 1, it's an always-on trade style. Number 2, I will use SPY as the underlying. Number 3, I will own 100 shares of SPY. Number 4, I will include a commission of $1 per options contract and 0 per share of stock or ETF in commissions. Number 5, I will allocate enough positions to use all available regular margin when applicable. Number 6, I will run the test through all 4 market types. In this video will be a test on the sideways market for a covered call. I will refer to this market type as market type 2. So the market types are market type 1, the 2017 bull market, market type 2, the 2015 sideways market, which is from January 1st to June 30th, 2015. Market type 3, which is the 2018 grind down market. Market type 4, which I will use the 2008 crash market. What I'm going to do is I will sell 40 delta calls that expire in approximately 30 days, along with holding 100 shares of stock. And I will wait for the call to expire before selling another call or reestablishing a new position. By the way, if you're interested in the software I use to perform my backtest and monitor my positions, it's called Options Net Explorer. And I left a link in the description of my experience with Option Net Explorer and a link for a 10% discount off of the software. Okay, so let's get started here. I'm going to trade SPY. Let's go to 2015, January 1st. It's not a trading day. We'll start on January 2nd. I always like to start at 7:15 just for consistency. First thing we're going to do is buy 100 shares. Commit that, call it trade 1. And we're going to go 30 days out. Here's 7 days. So 28 or 35, we'll take 28. We'll go to the delta of 40 minus 1. We're going to sell that. We'll add that to the position. And you can see down here we're using around $10,000 in margin. And let's see, this is on January 30th when this expires, so we'll go there. On the last day, we're going to buy it back. Buy that back for 0. Now we had a 208 call. And looks like we're trading around 200, so we did not get called away. So we're going to continue to hold our shares and sell another call at the 40 delta. So here's one that's 28 days and 35, so we'll take 28 days, 41 delta. Here's a 41, that's the closest. We'll sell that one. And we'll pick up $2.60. Now, when does that one expire? It expires on February 27th. We'll go to the 27th of February. Okay. So 0 days, we're going to buy it back. We always want to close these out because the software doesn't really like it if you don't close out positions and you let them expire worthless. Okay, so here, now you can see this has value, so I'm going to take that value away. So we're going to call this 0, but I need to remember the strike price of 203 because that's what I'm going to sell the stock for. So we got called away at 203, so minus 100 shares. What price? 203. Okay, now we're going to just start over. We're going to buy 100 shares. 100. We're going to buy those shares at 211.50. Call it trade 2. And we're going to sell at 28 or 32 days. Let's take 32 days on the call. Let's go to 38s. They're closest to 40 delta. We'll sell that one. And we'll pick up $1.52. So, you know, the margin here, 10,558. So I'm probably going to use $11,000 as my capital outlay. Okay, so this was on March 31st. March. So let's buy this back. And looks like we didn't get called away because there's no value in this call. Buying it back. The 213. Yeah, we're down here at 207, so we didn't get called away, so we're still holding these shares, and we're going to go out 30 days. Here's 31 days, and 42 delta, as close as I can get to the 40. Pick up $2.35. When does that expire? 1st of May. Let's go there. May 1st. Let's buy this back, see if it has any value. It does have value. 209, 209.94. So we did get called away. So we're going to sell the shares at 209. We're going to make this 0. We're going to keep all that premium. But we're going to sell these at 209. And we're going to start over. So we're going to buy 100 shares. Whatever the price is. Trade 3. Let's sell a call. 28 days looks closest. 38 delta is closest to 40. Let's sell that one. Pick up $1.67. And when does that expire? 29th of May. May 29th. Let's buy that thing back. See if it has any value. Well, it has 30 cents. So 212 and 211. So we're going to buy this back and we're going to keep our shares. We did not get called out. Okay, so we'll keep our shares. We're going to go to 28 or 32 days. I'll go with 32. 40 delta. Ooh, maybe there's something better over here at 40 delta. Yeah. 43, I guess, is closest. There's one. Pick up $1.93. When does that expire? June 30th. Let's go to June 30th. Oh, that's right at the end of the sideways market. So that works out. We'll buy this back at 0, as I always do. Oh, looks like the market went down. Okay, there's no value in there anyways. And because we're at the end of the sideways market, we're going to go ahead and sell out these shares at whatever price we can get for them. So that would be 206. Okay. Let's take a look at the report, see what happened. Okay, this looks like our report here. We did 3 long positions. We sold more than 3 calls. Let's look at the Analyze tab here. So we did well until we got to May, and then we kind of went down a little bit. Looks like we made about $330 in that 6-month period. I'm going to go ahead and take a look at the just buy and hold so we can compare that. Okay, so next let's just run that buy and hold strategy. We'll go to January 2nd, 7:15. We'll buy 100 shares. And then we'll go to June 30th, same time of day. We'll sell it. Now we can go to reports. And we have our report here. Look at the analysis tab, obviously straight equity curve, but looks like we made $24. So basically didn't really make any money, just broke even, which is what happens in a sideways market, which means that the $330 definitely is better than $24. Let's run some numbers with that. So the margins, we're just going to use $11,000 just to make sure that we didn't miss anything. And let's go with our calculator here. 330 divided by 11,000. It's about a 3% return using the covered call strategy. 24 divided by 11,000 is not even 1%. So, you know, Definitely the covered call strategy in this circumstance, the way that I did the backtest, outperforms the buy and hold strategy in a sideways market, and you would expect to see that. Hey, don't forget to hit that like button on the way out.